Hello everyone, Mary here, and today I will show you why I don't save money in the bank. And when I say bank, I mean the traditional brick and mortar. In this video, you will discover why banks make you poor and what you can do about it. The sad reality is that financial basics is something that most people did not learn in school. We graduated high school and college learning about English, math, science, history, but most of the time we have very little knowledge about finances. When we start working, what do we do with our paycheck? How do we budget? How does the banking system work? And how does compound interest work? These questions are very practical and something that we should know about. Personal finance is an important part of life that is often neglected, and that is a huge factor why a lot of people are in debt and struggling financially. This channel is about finances and how it can help you to make simple change that is needed so that you can get ahead financially. So click the subscribe button below to discover simple strategies that can benefit you. Now, listen to this scenario very carefully because what I'm going to share with you is something that you should not take for granted. This is about your hard earned money. So, here's the scenario: you work so hard, and after 2 weeks or after a month, you get paid. When you get your paycheck, your salary goes directly into your checking account. Employers usually ask for direct deposit forms, so it's more convenient to pay you. Plus, banks, they give great deals for you to set up a pre-authorized deposit, and you will find out in this video why. So let's continue to the story. Of course, when you get your paycheck, you have to pay your bills. And after all the expenses, let's say you have a surplus of $1,000. What are you going to do with your surplus? Some people just leave it in their checking account. A checking account is designed for day to day banking, making purchases and paying the bills, something that you can access and withdraw anytime. Some people will transfer that extra money to a savings account, which is ideal for money that you don't need to access every single day. And in this account, you get interest on your money, which is usually less than 1%, pretty much next to nothing. You might say, yeah, that's what happens, but how does that affect me, Mary? How does that make me poor? Listen to this, and this is how the banking system works. Let's see what happens to your $1,000 that you just left sitting in your bank account. Do you think the bank will just keep your money there in a safety deposit and wait for you to get it after 5 years or so? Of course not. They have to let that money work so they have something to pay you for the interest that they promise. So let's say you deposit 1,000 in your bank account and the bank promised you 1% interest on your money. The bank will then lend your money to a borrower and charge them a higher interest rate, let's say 6%. The difference they charge on their loan and the interest that they pay you is the profit that the bank makes. So basically, you are letting the bank make money from your money. But the bank cannot just lend out the whole $1,000 deposit to the borrower. They are required to keep on hand a certain amount of cash that depositors give them. Most banks are required to keep 10% of the deposit, referred to as reserves. Not all banks have reserve requirement, but for this example, let's say the bank has 10% reserve requirement. So they can only lend out 90% of your $1,000 deposit, which in this case is $900. Here is where it gets interesting, and this is how banks create money. So let's say your neighbor Mark borrowed $900. This $900 that Mark borrowed is now considered to be the new money created because remember, you still have your $1,000 in the bank while Mark, who borrowed the money, now has 900. In total, 1,900, which came from your initial deposit of $1,000. Now, if Mark deposits the 900 into his account, the whole process can be repeated with a new borrower. This time, 810 will be loaned out, and that is new money created again. And the process repeats and so on down the system. You know where it's going. So in this case, I only used $900 loan that is created from the initial deposit of 1,000, but in reality, we are talking about huge amounts like mortgages and car loans and personal loans. There are deposits being made from these loans, and it's a lot of money being created. So you might say, how does that affect me, Mary? I'm the one who initially deposited the money in my savings account. I still have my $1,000 deposit there, right? Here's what you need to understand about this money creation process. And this is a basic economic principle that when supply exceeds demand for a good or service, prices fall. So in this case, the supply of money increases faster than the amount of goods and services available. So in this case, when the supply of money increases faster than the amount of goods and services available, what happens to its value? It decreases. So the value of your $1,000 decreases because of all the money being made. So you are losing money because the money you save today has less value tomorrow. And most of the time, people just leave their money in their bank account for years. And that makes you poor because the money is just sitting there losing its value. This is called inflation, which is the decrease in the buying power of your money. For example, 30 years ago, you can buy 1 pound loaf of bread for 75 cents. Now it costs way more than that. So when you save your money in your bank with less than 1% interest rate, it cannot even keep up with inflation, which on average is about 2 to 3% in Canada and the US. So what can you do about it? Like I said, this channel is about finding that simple change that will help us to get ahead when it comes to our finances. Now that you have this information, you can either keep saving in your bank and lose money over time, or check out other options on how you can make your money work for you and even do what the banks do. You can do that, and there are ways to do that, which I'm also going to discuss in my future videos. The simplest thing that you can do about it is to open an online savings. Not a traditional bank, but an online bank account. Maybe 10 years ago, we won't consider this because it was so much different back then, but this is the present where we do almost everything online. And even the traditional banks offer online services. So these online banks can offer a higher interest rate because they don't have so much overhead. And the interest rates that they offer at least keep up with inflation. Or you can also start getting into the stock market. There are platforms that you can use like Wealthsimple Trade, Questrade, or direct investing in your own bank. Or you can also buy bonds and ETFs. There are so many options that you can do with your money, but of course, it still depends on your goals, whether you want to use it for your short-term or long-term goal. So look into that, and whatever decision you will make when it comes to your finances is entirely up to you. Again, thank you so much for watching this video. If you find value in it, click the like button and subscribe to the channel. Until next time, take care.